Be Wealthy and Smart, episode 493.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about the best and worst stock performers in 2018. This comes to us from a MarketWatch article written by Philip Van Doorn. Well, this year has been quite the roller coaster, and in fact, half of the all-time up or down days in the top 20, 10 of those have happened in the last year. So we've had a lot of volatility that we didn't have the previous year. We had in 2017, as you remember, a year of almost no volatility. And this year we have extra volatility making up for all of that. It's been a wild roller coaster ride, and a lot of people are getting a little nervous, finally. And I say finally because for a long time, there was no fear in the market. Nobody was worried. Nobody was reacting to the market swings. And finally, we're getting some fear back in the market, which is actually a good thing. You can't have people being overconfident about the market. That just doesn't work. You need to have people have their fear and doubts. That's what makes bull markets go up. Markets climb a wall of worry, as Wall Street says, and that's very true. You have to have that doubt in your mind, that little bit of fear, that what if, that acknowledgement of risk in the market, and realize that markets go up and down. They do have swings, and it is going to be an emotional roller coaster. That's just the way stock investing is. So none of us like it, none of us feel comfortable with it, but it's something that goes along with investing. And that contrarian mindset of what Warren Buffett says, be fearful when others are greedy and greedy when others are fearful. And that is summing up the contrarian investor mindset. All right, well, let's look at this MarketWatch article, and I'll make some commentary along the way, but we're going to be reviewing what stocks, meaning what companies, have been performing the best in the S&P 500. So these would be looking at the largest companies in the U.S. And that doesn't mean that these have been the best in the entire stock market, because it's quite possible that smaller companies, which actually have been outperforming, the small caps, have been outperforming for a while. It's quite possible that there are many stocks that are much smaller companies that have been performing better. So I just want you to realize we're not looking at the entire stock market. We're looking at just the largest 500 companies and which ones have done the best. The headline says, the healthcare sector is the big sector winner, and no FAANGs make up the top 10. I just want to pause right there and say, I'm not surprised that the FAANGs are not in the top 10. Of course, we're talking about Facebook, Apple, Amazon, Netflix, and Google, or Alphabet. And the FAANGs in the last year have really been attracting most of the market's capital. In fact, in my VIP experience group, I've been talking about how when you have a narrowing market and all of the money is going into a very few number of stocks, which is exactly what we've been seeing, that is usually an indication of a top, not a bottom. So it's indicating that those few companies are peaking out. They're not necessarily going to be the market leaders in the future. And let me just give you an example of that. So Apple is down already 20% this year. And although it reached its big $1 trillion valuation and got a lot of fanfare and cheering on the financial media, it has had declining sales on their new iPhones. And when you have declining sales and you're starting to discount and you're starting to lose market share. These are not the characteristics of a top company anymore, because to be a top company and to be a top performer, you usually want to have rising earnings, and even rising earnings at a rising rate. So if you're not going to have rising earnings anymore, that could mean that your best days are behind you, at least until a whole nother market cycle comes out and they come out with some great new technology that everybody wants to own, and everyone gives up their old iPhones and goes out and buys a new one. But if they are having declining sales and declining revenue, that is not good for the stock, and that is going to take the valuation of the stock down. So just to be aware of what is really going to move stock prices in the end, it's going to be their sales, their profitability, their rate of sales growth, and their consistency of sales growth. And we saw that for a long time with the FAANG stocks, but now we're seeing some weakness and we're seeing some other things happening. All right, back to the article. What it says is, considering how much coverage there has been of the strengthening U.S. economy, demand for workers, and a massive tax cut that has boosted corporate earnings, 2018 has been a disappointing year for the stock market overall. Investors seem to be disappointed as they look ahead. The Dow Jones Industrial Average has returned 3.5%, with dividends reinvested through December 4th, while the S&P 500 index has returned 2.8%. As the year nears its close, it's time to look at what stocks have fared best and worst. So first we're going to look at the sectors that have performed the best. And why I like to look at the best performing sectors is because oftentimes a rising tide lifts all boats. So if a sector is doing well, usually a lot of companies in that sector are doing well, right? That's what's making the sector do well. So if that's the case, sometimes you might want to look at putting some of one of these sectors in your asset allocation, in that extra 10% that I talk about that's kind of the wild card that you can put some money into and have working for you in a sector. So the number one sector is healthcare, up 14.3% year to date. Then utilities were up 9.6%, consumer discretionary 8.1%, and consumer discretionary are things that are not essentials for consumers, but they're things that are desirable for them to purchase. So it could be things like apparel, entertainment and leisure, and automobiles. And typically, consumer discretionary is something that is influenced a lot by consumer confidence and by the state of the economy. So if the economy is doing well, people tend to feel more comfortable and spend more on these things. These are things that people would put off buying if they aren't feeling good about the economy. The next category is information technology, was up 6.9%. The next category is real estate, up 4.6%. I want to pause here and just say that real estate, of course, you've got a very broad category there. I will say new housing starts are down 18% year to date. So we know one particular part of the real estate market is suffering a lot, and that would be new homes and sales of new homes. But in this sector overall, real estate is still up 4.6% year to date. The next categories on the list all actually have negative returns year to date. So only these 5 sectors in the S&P 500 had positive returns year to date. That was healthcare, utilities, consumer discretionary, information technology, and real estate. Now, the next categories have negative returns. Consumer staples were down 0.9%. Consumer staples are things that people buy no matter what the economy does. So no matter how well the economy is performing, they're going to buy these things. You have to have them. Things like food, beverages, everyday household items, your typical consumer things that you buy at the grocery store, the drugstore, things like that are things that you're going to continue to buy no matter what the economy is doing. The next category are financials, down 5.8%, industrials down 6%, energy down 6.8%, communication services down 8.5%, and materials down 9.6%. Again, the S&P 500 index is up 2.8% year to date. So you can see some of these sectors did much better than that, and then we have those that are not doing as well. The article goes on to say the healthcare sector is this year's big winner, and that may not be much of a surprise considering the demographic trends, innovation, and overall increase in spending. But you might be surprised that utilities have performed so well. In fact, they have beaten the performance of the S&P 500 for most long-term periods, showing perhaps how comforting it can be to invest in companies with protected monopolies and municipal contracts that ensure profits. The table also shows how the index and sectors have performed so far in the fourth quarter. Poorly overall, but utilities have shined. Your utility companies would be things such as gas, power, your electric, and water. The article goes on to say, based on weighted aggregate estimates, analysts expect S&P 500 companies to increase their earnings per share by 23.6% this year from 2017. But that factors in a massive cut to the top federal corporate income tax rate to 21% from 35%. So I want to pause there and say that is a huge point. These companies had massive reductions in taxes. A lot of them chose to buy back their stock with those savings, and some of that has helped to push up some stock prices. But they're not going to have that advantage for next year. So these are things that we have to think about because they're going to organically have to grow their business in order to get such a big increase in profitability next year. Then the article has a chart of earnings per share that are expected to increase for the next 2 years in different sectors. I'm going to not review that, but I'll leave a link to the article in the show notes and on my website. And we're going to get to what you want to hear about, which is what are the top 10 winners and losers in 2018? Well, here's what's done best year to date. The number one performing company on the S&P 500 has been Advanced Micro Devices, symbol AMD. Its return year to date is 105%. It is a semiconductor company, and although it's been up 105% year to date, since the correction that started at the end of September through early December, it's been down 32%. The next best performing company year to date is TripAdvisor, symbol TRIP, up 83% year to date. The next best performing company is Advance Auto Parts, AAP is the symbol, and it's up 79%. The fourth best performing company is Abiomed Inc., symbol ABMD, up 75%. The next company is Fortinet, symbol FTNT, up 68%. The sixth best performing company is HCA Healthcare, symbol HCA, up 64%. The seventh best performer is Chipotle Mexican Grill, symbol CMG, up 62%. The eighth best performing stock is Under Armour, symbol UAA, up 62%. The ninth best performing company is Illumina, symbol ILMN, up 53%. And the 10th best performing company is McCormick & Company, that's the food company, up 51%. So those are the top 10. Again, Advanced Micro Devices, TripAdvisor, Advanced Auto Parts, Abiomed, Fortinet, HCA Healthcare, Chipotle Mexican Grill, Under Armour, Illumina, and McCormick & Company. And in the article, you can click on the tickers for more information about the company, their news, their profiles, their estimates, charts, price ratios, and ratings. So they did a really good job with giving you ways to get extra information about any of these particular companies. The article goes on to say, Advanced Micro Devices, AMD, is this year's winner, at least so far, exemplifying how volatile an industry group semiconductors can be. The stock has more than doubled this year, even though it has fallen 32% during the fourth quarter as the information technology sector has pulled back 11%. What's missing on the list? A mention of any of the so-called FAANG stocks: Facebook, Amazon, Apple, Netflix, and Google parent Alphabet. After big gains for much of the year, all have now plunged more than 20% from recent peaks, putting them in bear market territory. That's even though some still have sizable gains for the year to date. It is human nature to want to pile on a recent winner. Investors also shy away from bargain shopping among stocks that have been falling, even when recent decliners include companies they long admired, but whose stocks they have believed were overpriced. George Young of Valere & Company recently discussed this psychological trap that hurts performance. Then it goes on to give a summary of analyst opinions about the top 10 S&P 500 stocks. Now we're going to talk about this year's 10 worst performing stocks in the S&P 500. The worst performing stock in the S&P 500, again, just in the biggest 500 companies in the US, not in all stocks in the stock market. The worst is Coty Inc., ticker COTY, down 59%. General Electric, symbol GE, down 57%. Mohawk Industries, symbol MHK, down 56%. Affiliated Managers Group, AMG, down 48%. Newfield Exploration Company, symbol NFX, down 45%. Western Digital Corporation, symbol WDC, down 45%. Invesco, symbol IVZ, down 44%. Dentsply Sirona, symbol XRAY, down 44%. L Brands, symbol LB, down 41%. And PG&E, symbol PCG, down 40%. Interesting there that PG&E has done so poorly when it is a utility company, and the utilities in general have been doing pretty well. Remember, utilities were the second best performing sector, but they were down 0.3%. But still, year to date, that was the second best performing sector, and yet we have PG&E, which is not having a good year at all. The article goes on to say, surprise, General Electric isn't the worst S&P 500 performer of 2018, at least through December 4th. Rather, it's Coty, which has been on a steadily downward path since February. The beauty products manufacturer named Pierre Lobby as its new CEO on November 12th after a disappointing earnings report sent its shares down 23% on November 7th. I want to pause there and say, there's my point right there. A disappointing earnings report sent its shares down 23%. The stocks are going to move based on profitability and earnings. So if they're not moving in the right direction, if they have a disappointing quarter, if their numbers aren't coming in, if their profitability isn't there, if their sales growth isn't there, that's what's going to drive a stock price down. Then the article goes on to have a chart about a summary of analysts' opinions about the worst S&P 500 companies, the 10 worst that I just reviewed with you, and you can click on that and read all of the information that they have compiled there about those companies. So there you have it. Healthcare remains the number one category, outperforming the FAANGs. A lot of what's behind healthcare's growth are demographics and people needing more medical services as they age. And with the baby boomer population being the large aging demographic in the United States, it doesn't surprise me at all that healthcare is getting a big portion of the earnings and the return in the S&P 500. So in summary, we're seeing the leadership from some of the past companies roll over into some different sectors that are finally winning, like healthcare, utilities, and consumer discretionary. We also see real estate still in the positive, but also not as strong as it's been in past years. We're definitely seeing signs of weakening in real estate markets across the country, particularly in the big markets, San Francisco, Seattle, Dallas, and Denver, as I reported on a real estate podcast recently. If you haven't listened to that, I recommend you go back and find out what's going on in those 4 big cities. And also in high-end luxury real estate, we're seeing a lot of weakening there. So real estate is having some major shifting going on. Technology has some shifting happening. And we're seeing healthcare continue to be strong. We have tremendous strength in consumer confidence, which means consumers are out spending more. Although physical store locations are getting a little bit less this year, we're seeing more sales go to online retailers. But still, people are spending, people are out there shopping, and the economy is looking very strong overall. We still have our Holiday Sizzle promotion going on. You have a very good chance of winning 25 prizes that are up for grabs, including a wealth mentoring session with me for half an hour of $500 value, my new book, Personalized by Me, and my Wealthy Mindset Blueprint audios worth $197. All you have to do is leave a podcast review that gets your name entered into the hat 2 times. If you write a book review on Amazon and you purchase the book somewhere else, your name gets in the hat 3 times. If you do a book review on Amazon and it's a verified purchase, meaning you bought the book on Amazon, your name gets entered into the hat 5 times. And if you do both a podcast review and either a verified or unverified book review on Amazon, your name gets entered into the hat 10 times. Names of winners will be drawn and announced on January 1st. If you haven't joined me yet on Instagram, go on over to instagram.com/Linda P. Jones and get your daily money tips. And don't forget to subscribe to Wealth Heiress TV on YouTube. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.